Welcome back to Investing Talk Podcast.
Today we're looking at Salesforce.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us keep the lights on and keep these deep dives coming.
So, setting the stage here.
Yeah.
When you think of Salesforce, what's the immediate image you get?
I mean, probably that ubiquitous, slightly clunky blue interface.
Right.
Where sales reps are basically forced to log all their calls.
Exactly. It is the absolute definition of a system of record.
Yeah.
But for this analysis, we are looking at a company attempting, well, perhaps the most difficult high-wire act in the entire tech sector right now.
Which is?
They are trying to pivot from being this massive static container for data into a dynamic AI agent powerhouse.
And looking at the headlines, the numbers they're throwing around are just, they're absolutely astronomical.
Oh, completely.
We're talking about a $50 billion buyback program.
Yeah.
Which is, I mean, that is a staggering amount of money.
It's the GDP of a small country.
Exactly.
Yeah.
And yet, if you're looking at the charts, the stock price isn't exactly behaving like a rocket ship.
No, it's not.
It feels a bit like the market is just sort of shrugging its shoulders.
Right. And that really sets up the central conflict of our whole discussion today.
Okay.
Because on one hand, you have massive headline numbers, soaring revenue from their new AI products, huge capital returns.
But on the other hand,
you have a market that seems totally unconvinced, effectively just crossing its arms and saying, show me.
right, and that is exactly where the skepticism kicks in. Because you have to ask, is this buyback just a giant financial engineering lever?
To mask slowing growth.
Exactly. Are they just another legacy tech giant burning cash to prop up the share price? Because, frankly, they've run out of big ideas.
Or is this Agentforce thing their new AI platform and actually showing up in the bank account?
Because, let's be honest, every company from your local bakery to Microsoft says they have AI now.
Yeah, the buzzword fatigue is real.
It really is.
Yeah.
We need to see if it's actually moving the needle.
Well, that is the perfect place to transition into the fundamentals. Let's move into the hard numbers.
Sounds good.
Because when you strip away the marketing and the glossy presentation...
And all the buzzwords.
Right. The financial report tells a very specific story about a company at a major crossroads.
Okay, let's look at the scorecard. We're looking at the Q4 fiscal year 2026 review.
Yep.
Revenue came in at $11.2 billion.
Which is up 12% year over year.
And for the full year FY 2026, they hit $41.5 billion.
A 10% increase.
Which is solid.
It's very reliable. But let's look ahead because, as you know, markets trade on the future.
Always.
Their guidance for fiscal year 2027 is projecting revenue between $45.8 and $46.2 billion.
Okay.
That implies about 11% growth.
And here's where I have to play the cynic for a minute.
Go for it.
11% growth. For a company pitching itself as the leader of the enterprise AI revolution,
I know.
that feels, it feels respectable, safe, but it doesn't feel explosive. If you're an investor looking for a high-growth tech narrative, 11% is sort of utility company territory, isn't it?
It's certainly not NVIDIA numbers.
Exactly.
And on the surface, I see exactly why you'd say that. If you just look at the top line, it looks like a mature, slow-moving giant.
Right.
But you have to look under the hood at where that growth is actually coming from.
Okay, lay it out for us.
This is where the story gets fascinating. It is all about the Agentforce growth engine. We really need to talk about Data360 and the Agentforce platforms.
All right, break that down. What exactly is the difference between this and just having a database with a standard chatbot attached?
So these platforms just hit $2.9 billion in annual recurring revenue, or ARR.
Wow.
Yeah. That is a 200% jump year over year.
200%.
Yes.
Yeah.
And if you isolate Agentforce, which is their specific AI agent builder, that alone is at $800 million in ARR.
Okay, well, 200% growth is definitely not utility numbers.
Not at all.
But let's clarify Agentforce for anyone listening who might be thinking this is just, a slightly smarter customer service bot.
Right. This is the crucial distinction to make. A chatbot like the ones we've all interacted with for years just retrieves information.
It summarizes a document or answers a basic FAQ.
Exactly. An agent performs actions.
Okay.
Agentforce allows a company to build digital workers that can say, oh, a new lead came in. I will qualify it, write the email, schedule the meeting in the calendar, and update the CRM record.
It's actually doing the work.
Yes. not just chatting about it.
So it's essentially the difference between a librarian pointing you to a book and a personal assistant who reads the book and writes the report for you.
That is exactly it. And reaching almost $1 billion in recurring revenue for a new product line this quickly.
That's fast.
It's incredibly rare in enterprise software. It proves that this isn't just vaporware. Companies are actually paying real money for it.
But who is paying for it? Because if they're just burning cash on marketing to acquire brand new customers, that's one thing.
And that is the key metric right there. 60% of these bookings are coming from existing customers, which means their upsell strategy is working perfectly.
So they go to their massive install base.
Yeah.
The companies that already run their entire business on Salesforce.
Right, and they say, hey, turn on these AI agents to make your data actually work for you.
And the customers are just saying yes.
They are saying yes.
So they are mining their own backyard.
Yeah.
That makes a lot of sense. It is so much cheaper to sell to someone who is already cutting you a check every month.
Much cheaper than trying to go find a stranger.
Okay, let's talk about the backlog.
Let's do it.
Because revenue is what you book today, but backlog is what you're guaranteed to book tomorrow.
Right. For that, we look at remaining performance obligations, or RPO.
Okay.
This is essentially their locked-in future money. And it exceeded $72 billion.
$72 billion.
Up 14%.
Just to pause on that for a second, that is a massive safety net.
It's huge.
That is enough money to run the company for years, even if they didn't sell another dime today.
It really is a fortress. And even more importantly for the short term, the current RPO.
The money they expect to recognize in the next 12 months.
Exactly. That is up 16%,
Okay.
which shows strong short-term health. It means customers aren't just signing vague long-term deals to look innovative.
They are committing to spending money right now.
Right now.
Okay, so the top line is growing, specifically in that critical AI sector.
Right.
But what about profitability?
Good question.
Because for a long time, Salesforce was really known for growth at all costs.
Oh, yeah. They used to spend money like it was going out of style.
Buying companies left and right.
Slack, Tableau, MuleSoft.
Exactly.
Well, that era is definitely over.
Really?
Yeah. Under heavy investor pressure, they've really tightened the belt. Their gross margins have expanded to over 78% on a GAAP basis.
Wow.
And their non-GAAP operating margins hit 34.3%.
So they have become an incredibly efficient machine.
Very efficient.
And that efficiency turns into cash.
Massive amounts of cash. They generated $15 billion in operating cash flow in fiscal year 2026 alone.
A cash printing machine.
Truly.
Which brings us to the moat.
The competitive advantage.
Right. Why can't a startup just come in and do this cheaper? Why not just use OpenAI or Anthropic directly? Why pay Salesforce this massive premium?
It comes down to data gravity and incredibly high switching costs.
Okay.
Once you have all your customer data, your sales pipelines, your service tickets, all of it, living inside Salesforce, moving off of it is a nightmare.
It's painful.
It's IT surgery. But the new moat is really the network effect of the data cloud.
Explain that data gravity concept a bit more for us.
Sure. Think about it like this. If you ask a public model a question about your specific internal sales pipeline,
It doesn't know the answer.
because it doesn't have your private data,
Right.
but Salesforce already has the data. They reported delivering 2.4 billion agentic work units and processing 19 trillion tokens. Yeah.
19 trillion. That sounds like a lot of tokens.
It is massive volume, and they are directly comparing themselves to Palantir here.
Really?
Yeah. Salesforce is claiming that because the data is already sitting securely in their cloud, the go-live time for deploying an AI agent is almost instant.
Oh, because you don't have to build a new infrastructure.
Exactly. You don't have to upload massive CSV files to some new vendor.
You just flip a switch.
You just turn it on.
So Palantir might have the really cool bespoke tech, but Salesforce holds the data hostage already.
Essentially, yes.
Yeah.
And ease of adoption is a massive competitive advantage when you are dealing with enterprise IT departments that absolutely hate complexity.
That makes total sense.
Okay.
So the fundamentals look robust.
Yeah.
Lots of cash, growing backlog, exploding AI segment.
Yep.
But let's use a verbal bridge here to pivot to the technicals. Let's look at the charts and the price action context.
All right.
Because if you're an investor looking at the stock price right now, you are not seeing a celebration.
No, you are not seeing a party at all.
You're seeing a flat line. Describe that price action context for us.
I would describe the current psychological state of the stock as neutral to pressured.
Okay.
It is effectively consolidating. It's stuck in a range. rather than breaking out to any new highs.
And this goes right back to that headline we mentioned at the very beginning.
The buyback one.
Right. Why Salesforce's $50 billion buyback didn't save the stock.
Yeah.
The market reaction was completely flat, despite them announcing they were going to buy back a quarter of their entire market cap.
Why? It is a classic case of what the market values right now in this specific moment.
Which is?
Investors in the tech sector are currently valuing growth expectations heavily over capital returns.
Unpack that. Why is a company giving money back to its shareholders seen as a negative, or at least just a non-event?
Well, a buyback is nice. It supports the earnings per share.
Right.
It definitely puts a floor under the stock, but it doesn't scream innovation. It screams, we have so much cash, we don't know what to do with it. The market wants to see the AI revenue explode even further. They want to see NVIDIA-style parabolic growth.
And even though Agentforce is growing fast,
the overall company is still growing at that 11% range.
So it signals maturity, not hypergrowth. And in this market, if you aren't hypergrowth, you're practically invisible.
Precisely. Plus, we have to look at the momentum and volume.
What are we seeing there?
There are no massive volume spikes. The stock is facing serious overhead resistance.
Right.
And let's be honest, the broader tech sector has been pulling back recently.
Led by declines in big names like NVIDIA.
Exactly. Salesforce is getting dragged down by the neighborhood it lives in.
Right. When the tech index sneezes, everyone catches a cold.
So true.
A buyback floor isn't enough to trigger a massive rally when the whole sector is feeling jittery.
It just isn't.
Let's bridge over to sentiment.
Okay.
How is the broader market feeling about Salesforce right now? If we had to put a quantitative score on it.
Quantitatively, the sentiment score is neutral. Literally a flat 0.
A 0? That seems harsh for a company making $15 billion in pure cash.
It is a huge disconnect, but when you look at the daily news cycle, it's completely dominated by other stories. You see headlines about massive layoffs at Block, or NVIDIA's earnings blowout.
The Salesforce just isn't generating a lot of noise.
Exactly. The only direct story making the rounds is that exact critique we just discussed.
That the buybacks are seen as neutral without more growth upside.
Spot on.
What about the institutional view? The smart money and the insiders. Are they buying the dip here?
Complete silence.
Really?
Yeah. There are no major Form 4 insider buy-in clusters. We checked the 13F filings for 2025. Nothing notable. Even looking at the big funds like the trackers for George Soros's fund,
Nothing.
there aren't any specific details regarding Salesforce accumulation.
So the insiders aren't panic selling, but they certainly aren't backing up the truck to buy more either.
They are in a holding pattern.
Waiting for what?
They are waiting to see if that fiscal year 2027 guidance actually holds up. They want proof that this Agentforce pivot is sustainable and not just a flash in the pan.
Are there any speculative catalysts? Any wild cards that could shake things up?
There is some speculation out there about a potential re-rating.
Okay, what does that look like?
The idea is that if Salesforce can pull off a pivot similar to what Palantir did, specifically regarding mission force.
The 2 force.
Yeah, which implies potential U.S. Army or major government contracts.
Wow, okay.
If they land those, the stock could be fundamentally revalued.
Because right now, it is valued like a legacy SaaS company. Boring, reliable, steady cash flow.
Right.
But if it gets valued as a critical AI infrastructure play.
The multiple expands immediately. The stock price goes up, even if the underlying earnings stay exactly the same.
Because the narrative changes.
Exactly. But again, we have to keep it grounded. That is completely unconfirmed.
Fair enough.
For now, the company is focused heavily on their stated goal, which is hitting $63 billion in revenue by fiscal year 2030.
Okay, well, we have been pretty balanced so far. But I want to bridge over to the risks. Let's look at the bear case.
It's important to cover.
Because there is a massive elephant in the room when it comes to AI and software seats.
Yes. The AI seat reduction thesis. This is, frankly, the biggest existential threat to their entire business model.
Explain it for anyone listening who might not be totally familiar with how Salesforce traditionally makes its money.
Traditionally, Salesforce charges per seat.
Meaning?
You pay for every single human employee who needs a login. If you have a sales team of 100 people, you pay for 100 monthly licenses.
Okay. But the entire promise of AI agents, of Agentforce, is that they do the work for you.
Exactly. If Agentforce works as advertised, an AI agent can handle the initial emails, the lead qualification, the tedious data entry.
So maybe one human can now do the work of 5 humans. So if I am a CEO and I deploy Agentforce, To cut my sales team from 100 people down to 20,
Yeah.
I am buying 80 fewer licenses from Salesforce. I'm paying them significantly less money.
Precisely. And we are already seeing this trend starting to play out in the broader market. Look at Block.
What happened there?
They reduced their headcount by 40% recently.
40%.
Yeah, that was a huge signal. If headcount drops across the entire corporate world, the traditional per-seat pricing model completely collapses.
That sounds like a death spiral.
Yeah.
You basically build the amazing new technology that cannibalizes your own legacy revenue.
It's the classic innovator's dilemma. You have to destroy your old business to build the new one.
It is. However, Salesforce does have a counterpoint to this bear thesis, right?
They do. They argue they can offset the loss of human seats via major upsells and, crucially, consumption-based pricing for the agent.
Consumption-based pricing.
Right. You stop paying for the person, and you start paying for the outcome.
Like how AWS charges for server usage.
Exactly. You pay $2 per customer conversation or per closed deal or per token processed by the AI.
That is a really risky transition, though. You have to get the pricing matrix exactly right.
Very true.
Because if you price it too high, nobody uses it.
And if you price it too low, you don't make up for all those lost human seats.
Yep.
It is risky. But if they pull it off, it could actually be way more lucrative.
Not so.
Think about it. A human employee works 8 hours a day. An AI agent works 24/7. It never sleeps.
True.
Its consumption could be massive. They are betting that the sheer volume of work done by these agents will be so high, it totally dwarfs the lost license fees.
It's like switching from selling cars to selling taxi rides by the mile. If people ride enough miles, you end up making way more money.
That is a great analogy, but it absolutely requires the customer to actually use the agents heavily.
Right. So the other part of the bear case is capital allocation concerns.
The buyback again.
Yes. I keep coming back to this $50 billion buyback.
Which is 25% of their market cap.
Exactly. If I am a skeptical investor, I look at that and say, why are you giving this money back to me?
Don't you have a better use for it?
Right. Don't you have R&D to fund? Don't you have massive AI growth opportunities to invest in?
It's a very fair question to ask. Does it signal they are just running out of ideas?
Exactly. The stereotype is that growth companies invest while mature, dying companies buy back stock.
That is definitely one view. The other view is that they are generating so much free cash flow that they can actually do both.
Both at the same time.
Yes, they can fund Agentforce aggressively and still return a mountain of capital to shareholders.
So it's a flex.
It signals incredible confidence. It shows they don't feel they need to acquire another massive company like a Slack or a Tableau just to buy growth.
They believe they can grow organically.
Exactly. But as we noted earlier, the market treated the announcement as a non-event. So the jury is definitely still out on whether that was the best possible use of $50 billion.
Sure.
Though having that buyback floor is much better than not having it. If the broader market crashes, Salesforce is sitting there ready to buy its own shares at a massive discount.
All right. We have looked at the good, the bad, and the neutral. Let's bridge to the final verdict here.
Let's do it.
Based on all the research, the fundamentals, and the sentiment, what is the final score?
I am giving this a bullish score of 8 out of 10.
8 out of 10. That is actually pretty high given all the skepticism we just discussed regarding the seat reduction risks and the boring stock price. Given the elevator pitch, why an 8?
It really comes down to one thing: product market fit. The 200% growth in Agentforce and Data360 proves that enterprise AI is real and that Salesforce is capturing it right now.
Okay.
Then you have the safety net. $72 billion in RPO.
Which is locked in.
That is a massive cushion that very few companies on Earth have.
It is really hard to bet against a company with $72 billion in guaranteed future checks coming in.
Exactly. And the buyback, it puts a concrete floor under the price. Even if the market is choppy, they are in there buying their own shares every single day.
Right.
And finally, the moat. The high switching costs deeply protect them from startups like Anthropic.
Because nobody wants to deal with a headache.
Exactly. You aren't going to rip out your entire CRM system just to try a flashy new chatbot.
Yeah.
Salesforce is embedding the AI directly into the workflow you already have to use anyway.
So it is really a safety plus growth play.
Yes.
It's not a speculative lottery ticket. It's a steady compounder.
Exactly.
So what is the target horizon here? Is this a trade for next week?
Absolutely not. This is a multi-year hold.
Okay.
You are waiting for that fiscal year 2030 revenue goal of $63 billion to fully materialize.
So patience is required.
Very much so. You are betting that the messy transition from human seats to AI agents will be successful over the next 3 to 4 years?
So the final verdict is it's a buy for the long haul, but definitely expect some chop in the short term.
The market just needs time to digest the transition, and the stock is consolidating while it waits.
But the engine underneath is firing on all cylinders.
That is the perfect summary.
Fascinating stuff. It is going to be incredibly interesting to watch if that Agentforce consumption revenue can eventually overtake their traditional seat revenue.
That will absolutely be the tipping point.
That is the metric to watch.
Yeah.
If the lines cross, the entire stock re-rates. Which makes you wonder, if these AI agents do successfully reduce enterprise software seats across the entire corporate landscape, what happens to the wider economy when all those sales and administrative roles just vanish?
It is a huge question we will all have to answer eventually.
Well, that is all we have time for today. Make sure to subscribe, like, and comment to this video to support the show. Let us know, do you think AI agents will replace entire sales teams or just make the humans faster?
I would love to read those comments.
Thanks for listening, and we'll catch you on the next one.